And I'm going to get started here on our presentation entitled The Mid-Year Outlook for 2017, A Shift in Market Control. And the emphasis on this presentation is pretty significant change that if you think about it, for the last 8 or so years, we've really been under the direction of monetary control. And what I mean by that is that we've had the Federal Reserve that has really been controlling to some extent a big aspect of our economy. And this shift means that we're going from this, if you want to call it, think about it, artificial scenario to a more normative scenario where the economy is really kind of on its own 2 feet. And if you want to think about the training wheels being taken off. So our shift here is that we're looking at a new growth engine and a powering up down of this monetary policy, but a powering up of business fundamentals. So really it's going to be companies who are going to have to provide the growth and the earnings that are going to propel the economy moving forward. So that's a huge change. I can't tell you how big that is. And there was a lot of concern for a good period of time from the Federal Reserve that if they did something like that, that it was going to cause, to push us back into a recession. So we're looking at the fact that the economy has met its dual objective of 2% inflation and fundamentally full employment. Okay, so some of the key things that we're going to look at are this slowing or powering down of monetary policy, a much bigger control and powering up of business fundamentals, a standby on economic growth to determine if this confidence really plays out, because we're not sure, excuse me, if it's going to succeed. It looks like it, and all the reports that I've seen recently on corporate earnings are very positive. And now it's really in 2017 and probably 18 where some of the current White House, the current administration's fiscal policies are going to start to take precedence. So that's again, just a huge shift. So right now we're looking for the U.S. economy to expand up to 2.5% in 2017. And if you think about the fact that we were down in the 1% to 1.5% range, that's a pretty big difference. Secondly, with regards to stocks, at the beginning of the year, our research department was predicting 5 to 8% returns. Now we're thinking more like a total of 6 to 9%, probably on the high side. We're looking at, although we're very cautious, as we can see here, on developed international markets. We'll talk about that in a minute. But we're really much more constructive on emerging markets. These are smaller countries, Vietnam and Malaysia and Romania, kind of much smaller countries than France and Great Britain and Germany, and Italy, etc. We really don't see, in fact, any virtual return on bonds. I mean, it's still going to be down in the 2.25%, 2.5%, maybe 3%. But if investors, retired investors, are looking for a supplement to their retirement income, it's going to be really hard to get that from quote, quote, safe, government or treasury bonds. So given this environment, we expect over the second half of the year, we're looking at investments such as these that we think are going to be very either positive or perhaps neutral. We'll talk about that here in just a second. So number one, U.S. small cap stock. Well, what is a small cap stock? It's really just a capitalization is a function of the number of outstanding shares that a company has issued times its share price. But, I guess it's kind of explanatory that, we look at small companies versus medium companies versus large companies. We're looking at small companies that are really the first out of the gate when we have a fiscal policy change. So with the current administration trying to foster business growth, these smaller companies are going to benefit first before the medium-sized companies and before the large-sized companies. They're going to be slower to react. Secondly, as we're looking at emerging markets, we're looking at the long-term trends of 6 billion consumers in these emerging markets. 3 is we're looking at cyclical sectors. And these include cyclical, what does that mean? Cyclical just means that as the economy improves or worsens, individuals will buy more or less of something, as opposed to staples, consumer staples, which are like toilet paper and diapers. You're still going to buy those no matter what the economy. Cyclical will mean things like technology, electronics, cars, motorcycles, things like that. So we're looking for cyclical sectors, including technology, because it's going to benefit from continued solid earnings growth as the business, as companies invest with a more deregulated environment that the current administration is advocating. We're also looking for industrials to benefit. Industrials meaning companies like Caterpillar Tractor, construction companies, companies that pave the roads, because again, the current administration is committed to, repairing our infrastructure, electrical grid, telephone grid, highways, roads, bridges. Also, financials should benefit quite a bit from a bit of deregulation that's going to free up capital. And this is going to create a better environment for lending, for the payment of dividends. Master limited partnerships is an area in which the administration has been very supportive, and these are specific tax structured oil and gas concerns. So these are expected to recover quite well with a market recovery. We did mention a bit ago that it's kind of tough to get much income from fixed income investments these days, and that's probably going to hold true for a while. But we think that if you do need income in retirement, you're probably going to maybe base a foundation on investment grade corporate bonds. Those are the highest paying, if you want to call it, investment grade, and those just mean non-junk bonds, corporates. If you want to get a little higher level of interest income, then you're going to look at perhaps mortgage-backed securities. And then finally, bank loans. And all bank loans are really, bank loans are a kind of a unique lending vehicle for companies that cannot get it through maybe more conventional means. And these loans also adjust their short-term interest rates as rates rise, or as maybe inflation rises. So as I mentioned here, the Federal Reserve is really powering down, and we expect only 2, maybe 3 rate hikes throughout 2017 as the central bank gradually removes the training wheels. It removes its support. We can think about the age of the business cycle and how we've had a pretty long sustaining bull market, but now we're interjecting new growth initiatives, deregulation, perhaps greater money for borrowing. That should help to maybe extend this bull market a bit farther. Monetary officials are going to need to balance their employment and inflation mandates with the potential U.S. dollar impact which has been largely range bound, which you'll see in just a second. And we're still looking at more monetary policy in Europe and Japan. So it's still difficult to get much interest from international companies. So we're looking here, we're seeing that the better U.S. growth and low unemployment will be accompanied by a core inflation pushing somewhere above the Fed target of 2%, which supports their normalization initiative. But there's still enough forces pushing down inflation. And these include things like excess manufacturing capacity, a low labor force participation rate, more stable dollar. So we don't see a significant uptick of inflation at the moment. Job creation is starting to slow a bit, and ironically, it's because we're reaching full employment in some parts of the country. So that's now that in of itself will not most likely contribute to inflation, but if we did see significant wage increases or salary increases, hourly wage increases, that could be a key contributor to inflation. So it's definitely something that we're going to have to keep a watch on. I mentioned a bit ago here, the U.S. dollar has been largely range bound, and so these imbalances, we see this kind of up and down, and they occur if the dollar gets too strong or too weak relative to other currencies. And so one of the things that you'll probably see, like mutual fund companies and money managers come out with and say, well, when things were just going up and up, as we see, from 2014, 15 here, as things were going up all the time, well then, just passive indexed investing would work just fine. But now that we've got this up and down, this volatility, you might be better served from a money manager or a mutual fund company that is advocating and utilizing active management, meaning instead of just buying and holding, they will buy and they will sell, and they will buy and they will sell. So we'll have to see, the jury, as I say, is still out on that one. We'll see what happens. As far as any regularly scheduled maintenance, we see the GDP growth approaching 2.5%, with the potential for further acceleration next year as the fiscal policy of the administration starts to fall into place. Recent improvement in job growth with only, as I mentioned, moderate wage pressure may allow for consumption growth without too much inflation. Anticipated fiscal, meaning the White House, legislation may provide further incentives for businesses to invest in themselves in the future. And policy uncertainty remains a concern, and the greater clarity is going to be needed to convert increased confidence into economic activity. And on a little bit of a parallel, I don't know if you saw this, but I did read in the Wall Street Journal yesterday, I think, where Congress is still debating the Affordable Care Act, and now some of the company executives around the country are jumping up and saying, come on, make up your mind. 1 minute you're going to do this, and the next minute you're going to do that. How the heck can we plan anything? And so that's definitely an issue right now. Is with the if you want to think about aggressiveness of the current administration wanting to implement fiscal policy, it's going to take perhaps some raucous debate in Congress to make some of these things happen. So just something to think about. This is really, I thought this was very interesting to me. Although we're seeing this pickup in U.S. economic growth in 2017, again, I'm emphasizing the future fiscal legislation. We're seeing now where businesses may, in fact, invest in property, plants, and equipment to position themselves for future growth. Whereas in the last several years, instead of doing that, they would use low interest rates to return cash to investors by issuing debt and buying back shares or paying dividends, choosing the financial risk from more debt on their balance sheets over the economic risk of investing in their business. So that's going to be interesting. It should be, again, between this two-pronged change here of fiscal policy and current economic conditions, we may see measurable investment in companies for the first time in a long time, quite a number of years. But on the other hand, this is the other one that really kind of surprised me, is that productivity has slowed considerably. So this is really interesting. You think about it, back in 2002, our productivity growth was 3 to 4 times what it was in the last couple of years, last year, right? Wow, how is that possible? Well, that's kind of interesting. A couple possible reasons include, number one, diminishing returns from technology development. So that, we're reaching this law of diminishing returns that you can only automate so many things, number one. And this I thought was really interesting, is lost skills during the deep contraction in unemployment during the financial crisis. So I was in Michigan a few weeks ago, and I was on the West Coast near a little town called Holland, between Holland and Grand Rapids. And I was told by some individuals in the area that essentially there is a negative unemployment rate because there's such a demand for workers that companies are cannibalizing workers from each other. I also saw an article in the Wall Street Journal yesterday where the state of Maine has undertaken a campaign to reach out to people who maybe back in 2008, 9, 10, 11, or whatever, left Maine. They're trying to provide them an incentive or appealing to their loyalty or heartstrings to please move back to Maine. So these people left and went maybe to where I am here in North Carolina because the economy was a little better, or Texas, and now states like Michigan and Maine are hurting. They have, essentially negative unemployment. So with business fundamentals looking to get back, at the controls, again, we've slightly raised our forecast on the S&P 500, which is just a basket of 500 stocks which were picked to try to represent the economy. We're looking for stocks to see gains commensurate with profit growth, consistent with mid to late economic cycle performance. And this is key here. Corporate profits will be increasingly important for stocks. If they're going to have, a relatively, jumping ahead here, a relatively good administration and relatively low interest rates, and if profits don't result, they're going to do a hasty retreat. Now, again, I have seen in many publications, including the Journal, that there have been some very positive, profitability reports. So that's so far so good from what I can see. So again, corporate America is off to a good start towards hitting our earnings target. The first quarter earnings season was a very good one, with S&P 500s rising by a much better than expected 15% year over year. And that is huge. S&P 500 earnings were still up over 10% year over year in the first quarter. And even if the earnings trajectory slows some over the course of the year, as comparison with 2016 get tougher, business fundamentals may still point toward further growth in output and profits. Now, you may see articles talking about, well, this thing called the PE ratio, or price to earnings ratio. Um, and the PE ratio is just it doesn't really mean, it's not an absolute number. It's something to be used to compare relatively similar companies. So, to figure out which one might be a better buy. So if you have Home Depot and Lowe's and their earnings are exactly the same, but one has a higher price per share than the other, then its PE ratio is going to be higher. And as an investor, you would need to decide, am I willing to pay a higher price per share when, for say Home Depot versus Lowe's, when their earnings are identically the same? So, now, that's individually. Collectively, over time, the price earnings ratio, you can see here's some annual changes, but it's usually been around 12, 13, 14%. But now we're getting up into the 14, 15, 16% range. So the question is, have stocks become, quote, expensive? Well, I would say yes, they are more expensive than they were compared to their long-term history, because some stocks are actually hitting up in the 19, even 20 times earnings, like I said, as opposed to 12, 13, 14, 15, or even 16. But if we view that against interest rates and inflation, which are still near historic lows, we think the valuations still look fair to us at the moment. So we're going to jump over here to the global economy and markets, and we say don't push until ready, which that's why it's yellow. While we're seeing improvements in fundamentals of their stock markets, both economically and in corporate earnings, that's good. At this point, though, we prefer emerging markets to developed ones due to faster growth rates and lower valuations. So they're, lower prices. And there is stable growth in most of the emerging market companies, but we remain conscious of risks such as China. And kind of back to this comment about, investing in emerging markets versus developed markets. Well, if you think about it, in Europe, those developed markets still have to deal with the whole Brexit issue, which may take years. And I don't think anybody knows how that's all going to shake out, number one. And number two is, while it is being processed, it is going to be a distraction for some period of time. So again, as monetary policy has been a primary driver of economic and financial market gains, with the central bank support continuing, economic reforms are still needed to address some of the structural problems that are representative in international markets. So we're still still very cautious and to some extent hesitant on international stocks at the moment. Stronger earnings in Europe and Japan have powered earnings growth for the MSCI EAFE index. Holy cow. Well, all that really stands for is the Morgan Stanley Capital Index for Europe, Asia, and the Far East. And this is good, highly, a solid higher in 2017 after we saw earnings declines in 5 out of 6 of the last years. So our expectations for earnings have increased. They're not quite yet there, but we think they're around the corner. And careful not to overload. Danger, Will Robinson. We believe that the 10-year Treasury will push higher, and that our year-end target of between 2.25, 2.25, and 2.75 remains reasonable. Our bias is toward the upper end of the range, maybe as much as 3%, should Congress make meaningful progress towards fiscal stimulus. And despite our expectations for stability in credit markets, there are still what are known as tight spreads versus long-term averages. And we're going to see that in a second here too. So if we look at this, the orange line at the bottom is an investment grade corporate spread. So it's a spread, meaning the difference between an investment grade's corporate bonds interest and treasuries. So you can see it's only about 1 to 1.25% more, maybe 2, right? 1 to 2. So you're taking on a little bit more risk in order to get 1 or 2% more than what you would get with a treasury bond. On the other hand, we see now that high yield, and these are sometimes called junk bonds or companies with less than perfect credit quality. We can see that there was a time here in 2016 where you would get almost 9% more than a treasury, but now you can see how far that has dropped. That's dropped by half. It's down to 4%. So again, fighting for yield in the bond market is going to be tough, and that's caused a lot of investors to, and it's going to continue, to turn to dividend-paying stocks, fixed annuities, long-term CDs, fixed index annuities, master limited partnerships, global real estate, things that are paying a higher rate of interest than they are right now. So, although the Treasury is still showing their power relative to the German Bund and the Japanese government bond, we think that international demand may once again return as valuations become very attractive relative to these other currencies. So we're kind of closely watching some of that. There's also, you may have read or heard about, is China engaged in a currency war, et cetera. So a lot of that has a big impact on the international stage. So how do we invest? Well, as we mentioned earlier, we're looking at U.S. small companies benefiting from an accommodative monetary policy, future fiscal policy changes, emerging markets where near-term catalysts such as global growth, monetary policy, and longer-term trends of 6 billion consumers trying to get into the middle class emerging. Cyclical sectors such as technology, infrastructure, industrials, and financials. Master limited partnerships representing oil and gas concerns. Investment-grade corporate bonds, mortgage-backed securities, and bank loans to try to squeeze out a little higher yield. And on a sidebar, I do actually have, and I will send you out an email once this, probably tomorrow, because I will upload, you'll get a summary of this, and you'll get a copy of the presentation and the slides that you'll be able, the video, you can watch it. But I'll also include, if interest income is an issue for you, so, reply back to my email, and I'll send you a report that I have on strategies that I can use to try to help show you how to get a higher rate of interest from your retirement dollars. So, we mentioned a bit ago, active management, where fundamentals drive stock performance. This should favor more active investment strategies going forward. So, it'd be fine to maybe have your core equity portfolio in exchange-traded funds or index funds, but if you want to take advantage of and perhaps shield yourself from some of the volatility on the downside, you might want to consider complementing some of that with an actively managed investment strategy that can buy and sell on the ups and downs. So we're just looking here at lower correlations. Again, this is back to the comment about active management. So what is the 63-day correlation of S&P stocks with the S&P 500 index? So we can see that correlations are down right now. So the easy part of just holding and buying and holding index funds may have come and gone, as they say. So that's what I have for this evening for you. I want to thank you for your participation and your, as I say, rapt attention. You'll get an email at the conclusion of this that will provide you a copy of the slides, a copy of the video. You can watch it again. I will also be uploading it to my YouTube channel. So if a week from now, a month from now, you can't remember where you put that email, just go to my website at www.briantsikorski, that's BriantSikorski.com, and click on my YouTube channel, and there you will find this presentation, which you can watch again to your heart's content. So with that, I will say thank you and have a great rest of your evening.